When Taylor Swift gave massive bonuses to her tour crew, the internet exploded with one phrase: "It's just a tax write-off." Millions of people claimed she got the money back, that the IRS paid for it, that it was basically free. But here's the truth: that's not how tax deductions work. Not even close. Educational only, not tax or legal advice. Always consult your CPA. Let's rewind and break down what a tax write-off actually means, starting with the simplest example possible. I'm Ivy, your digital tax pro at Ivy Smart Tax. Today, we're correcting one of the biggest tax myths on the internet.
And I'm Alex, because I definitely thought write-offs meant free money until about 30 seconds ago.
Here's the simplest way to understand tax deductions. Let's say you spend $1 on a business expense, like a bonus to an employee. That $1 is tax deductible. But here's what people get wrong: a tax deduction does not give you the dollar back. Instead, it reduces your taxable income. So if you're in a 37% tax bracket, the highest federal rate, that $1 deduction saves you 37 cents in taxes. You spent $1. You saved 37 cents. Your net cost, 63 cents. You still paid real cash. You still lost money. The deduction just made it slightly less expensive.
Wait, so if I spend $100,000 on bonuses, I don't get $100,000 back?
Correct. You'd save maybe $37,000 in taxes, but you're still out $63,000 in real cash. The phrase write-off has been completely twisted by social media. Online, people use it to mean free money. But in tax law, that's never what it means. According to the IRS, a write-off is simply a deduction, an expense that reduces your taxable income. It's not a refund. It's not charity. It's not the IRS paying you back. It's accounting. You subtract your expenses from your revenue to calculate profit. Then you pay taxes on that profit. That's it. No magic. No loopholes. Just math. Let's get CPA technical for a moment. Under IRS rules, businesses can deduct ordinary and necessary expenses. What does that mean? Ordinary, common in your industry. Necessary, helpful and appropriate for your business. Employee bonuses? Absolutely ordinary and necessary. They're compensation, just like salaries. So when a business pays bonuses, they can deduct them. But the deduction only lowers taxable income. Here's the formula: revenue minus deductions equals taxable income. Then you pay tax on that taxable income. Example, revenue, $1 million. Bonuses paid, $200,000. Taxable income, $800,000. If your tax rate is 37%, tax owed, $296,000. Without the bonuses, tax owed would have been $370,000. So the bonuses saved $74,000 in taxes, but cost $200,000 in real cash. Net cost, $126,000 out of pocket.
So the business still loses money?
Always. A deduction reduces the pain, it doesn't eliminate it. Let's pause and reset, because this is the most important concept in this entire video. A write-off reduces tax. It does not erase cost. When someone spends money on a deductible expense, they save a percentage on taxes, but they still lose the majority of the cash. That's not a loophole. That's how business expenses work. Now, let's apply this to Taylor Swift. Reports suggest she gave out tens of millions of dollars in crew bonuses during the Eras tour. Let's use a hypothetical example. Assume she paid $50 million in crew bonuses. Because the business income passes through to her individual tax return, and she is taxed at the 37% top federal individual rate, that deduction would reduce her taxable income and save approximately $18.5 million in federal taxes. But she still paid $50 million in cash. Her net cost, $31.5 million. That's real money. Money that came from tour revenue. Money that affected her bottom line. She didn't get a refund. The IRS didn't reimburse her. She made a business decision to invest in her people, and yes, it was tax deductible, but it was absolutely not free.
So when people say it's just a write-off,
they're completely misunderstanding how taxes work. Now let's talk about the other side of the story, the crew members who received the bonuses. From the crew's perspective, this is taxable income. These bonuses are subject to federal income tax, state income tax, Social Security, and Medicare taxes. The bonuses are processed through payroll, just like regular wages. So if a crew member received a $50,000 bonus, they might pay $15,000 to $20,000 in taxes, depending on their tax bracket and state. Their net bonus, $30,000 to $35,000. This isn't charity. It's not a gift. It's ordinary compensation, and both sides pay tax accordingly. Let's address the elephant in the room. Was this a tax loophole? No. Here's why. Paying employee bonuses is standard payroll practice. There's no special IRS exception. There's no secret form. There's no hidden refund mechanism. This is how businesses operate. You pay your people. You deduct compensation as a business expense. You report it on your tax return. The IRS expects this. It's not creative accounting. It's not tax avoidance. It's normal business operations, scaled to $1 billion tour. What makes this story unique isn't the tax treatment. It's the leadership decision behind it. Here's what this story is really about: leadership. The Eras tour grossed over $2 billion worldwide. It ran like a machine. Minimal cancellations. Flawless execution. Zero major scandals. Why? Because Taylor Swift invested in her crew. She paid truck drivers $100,000 bonuses. She gave dancers, stage crew, and production teams life-changing amounts. And what happened? Those people showed up. They worked harder. They protected the tour. They stayed loyal. That's not a tax strategy. That's retention strategy. That's how you build a world-class operation. And yes, the bonuses were tax deductible, but the decision wasn't about taxes. It was about people.
So the lesson here isn't about tax write-offs at all?
Exactly. The lesson is, take care of your people and your business will take care of itself. Here are your 5 key takeaways. A tax write-off reduces taxable income, not the cash you spend. You always lose more than you save. The IRS never reimburses business expenses. A deduction is not a refund. Bonuses are ordinary income to recipients. They pay tax just like wages. This wasn't a tax loophole. It was normal payroll at a massive scale. The real story is leadership, not taxes. Taylor Swift chose to invest in her people, and that's why the tour succeeded. A write-off reduces tax. It doesn't erase generosity. If this video cleared up a tax myth for you, follow and subscribe now. At Ivy Smart Tax, we break down case study, audit risk, deep dive, and tax news like this, so you stay ahead of tax traps before they cost you 6 figures. Subscribe and download your free tax guide in the description. And stay ahead of the IRS the smart way.